for 2012 audit summary. Andrew? ParenteBeard.
Andrew's just setting up. I'm going to actually work with you. Once again, Andrea, the lady is a partner for this job, and she'll be going through the audit for the entire council.
Hi. How you doing?
Good night, Jerry. Good night, Jerry.
Good night. That's Jerry. Good night.
Good evening, everyone. Sorry for missing my Vienna. Okay, the presentation tonight is going to discuss the components of the county's financial statements. They are different from what you've seen in the past, so I thought it would be important to go through some of those changes because of under the new charter. Overview of the financial statements, our audit requirements and results, and then any questions. So your financial statements are composed of a management discussion and analysis. This is put together by the county manager and budget and finance director, and that is an unaudited document, but it gives you an explanation of what happened during the year compared to this is 2012's financial statements compared to 2011. And then you have the way governmental financial statements are set up. They have government-wide financial statements, which are full accrual basis of accounting, and fund financial statements, which you're typically used to seeing. That's a modified accrual basis of accounting. Similar to cash, but there are receivables and liabilities recorded. You have the notes to the financial statements, and finally required supplementary information. For the county, that includes your pension, progress funding, and also your post-employment benefit plan. So on the fund financial statements, which are included on pages 16 and 18 within your financial statements, you have the general fund, which accounts for the majority of the operations of the county. The Luzerne County Office of Community Development is another, what we refer to as a major fund. There's the Health and Human Service funds. This includes the Area Agency on Aging, Mental Health and Developmental Services, Drug and Alcohol, Children and Youth, and Office of Human Services. This is grouped as one major fund included within your financial statements. You also have the Debt Service Fund. This accounts for all the principal and interest payments that are made on your debt service. Capital Projects Fund is a separate fund that accounts for any bond proceeds to be used for capital. The Flood Protection Authority is considered a major fund within your financial statements. And you also have non-major funds, which are grouped together. They don't meet a certain threshold, but that's why they're grouped together. They're the 911 operations, hotel rental, liquid fuels, domestic relations, the airport. And there's some other special revenue funds in there, typically funds that have a specific purpose relating to a grant. Also within the fund financial statements are you have an internal service fund, and this accounts for the self-insured workers' compensation payments and claims. So you'll see later on that the general fund will budget for a transfer to fund those workers' compensation payments. Same thing with the pension trust fund, set up a separate fund to account for the retirement fund. It has separate investments, activity, and again, transfers from the general fund into the pension. And finally, the agency funds. These are really just an asset and a liability, just custodial in nature. That money is to then be dispersed out to the appropriate agency, or state or federal agency. So I'm going to really focus on the general fund in this presentation. This this is the fund that you budget for. So you'll see for 2012, the general fund budget for total revenues was approximately $113 million. Actual came in at $109 million. So it was under budget by approximately $4 million during 2012. The majority of that variance is really in the tax line, you'll see. And it really, there's two pieces that's budgeted for on the tax line. Your actual current collections, which came in at over 100% of budget, actually $792,000 higher than budget, but your delinquent collections only came in at 50% of budget, so $3.5 million less than budgeted. So that was the majority of the reason for the revenues being under budget. On the expense side, these are the expenditures before transfers. The budget was $85.9 million compared to $89.5 million, so it was over budget on the expenditure side by a net of $3.5 million. The biggest line there you'll see on the correction side was over budget. This was due to the budget had included layoffs that would have occurred at the beginning of the year. However, they did not happen until, I believe, in March of 2012, and there were other, so it was mainly salary related on the corrections line. Below the revenues and expenditures that I just described are these other financing sources and uses. These are your transfers out to other funds. If you hit that one more time. It's transferred out to pay for debt service, health and human service funds, approximately $4 million, and the workers' comp, $770,000. So the deficiency, so excess expenses over revenue was $7.4 million. You had begun the year in 2012 with $3.6 million fund balance. So going into 13, it was a negative $3.7 million. This slide is to show you some of the history of the deficit that has happened. I'll refer to it as a structural deficit when expenses exceed revenue. And you'll see that it's grown each year about $1 million. From 9 to 10, it was 5.6, 10 to 11, 6.4, and then this past year, the 12 year, it was 7.4. And you'll see what that has done to the fund balance. Back to 2009, it had been at 13.4. As I mentioned in the Budget and Finance Committee too, in looking back to 2009, that fund balance was not really a result of excess revenues over expenditures. It had been the result of debt being taken out, about $18 million of debt. So that, well, I'll say overinflated the fund balance in 2009, and then it slowly has been decreasing. Another way to look at the general fund revenues of the $109 million, 87% is coming from taxes. Again, I'm only focusing on the general fund. Those taxes, as I mentioned earlier too, what we typically see, and this can vary from county to county, but in the 60% range, 60-65% is typically on the taxes. And then there's probably more majority of the revenue is coming from intergovernmental grants and things like that. On the expenditure side, starting from the left at the 7%, that's the administration. It goes around to the right, judicial 25%, 27%, and around those percentages. And as far as the debt service piece of that, that was a large percentage of those expenditures. And this is your future debt service, you'll see for the next 5 years and then thereafter of your principal and interest payments. So it's approximately $25.2 million for several 3 years, and then it goes up a little slightly. Those are the comments that I have on the financial statement side. As far as the audit goes, this talks about our opinion that we gave on the 2012, and it clearly is now shows you within the opinion what the responsibilities of county management are for the financial statements and what the auditor's responsibilities are. So county management is to prepare and fairly present, in accordance with generally accepted accounting principles, the financial statements, and including the design, implementation, and maintenance of internal control. And then on the next slide, it's our responsibility to express an opinion on your financial statements. We give that opinion knowing that or assuming that they are in accordance with generally accepted accounting principles. If they are not, then we would have to qualify our opinion or give a different type of opinion. And then also, we do consider your internal controls when we design our audit procedures, but we don't express an opinion on your internal controls. So I am happy to report, I think this is a significant accomplishment on the side of the county in this year of 2012, was the fact that we issued an unmodified opinion. In the past, I'll say what you needed to do during 2012 in order to get that unmodified opinion. It was to adopt these governmental accounting standards. When I said in accordance with generally accepted accounting principles, that means that you have to follow all of the policies that are set by this governmental accounting standards board. And that one was 45, which is reporting post-employment benefit obligation. It was about $8 million. That was for particular employees within the county. Also, the recording of your derivative instruments, your swaps that you have in association with your debt, certain debt issuances. And GASB 63 was new this year, and that is the reporting of deferred outflows and inflows. It's different sections on your balance sheet that show assets and liabilities. In addition, other items that were not done in previous years that were audited, things were actually not audited within the financial statements. They were your capital assets, liquid fuels, and probation funds. And also there was a qualification about identifying related parties in your guaranteed debt transactions. So policies and procedures were put in place during 12 for those items. So moving forward, we are currently in the process of testing. As you know, you've done a conversion from ACS to New World. That was done in the middle of 2013, the conversion about July 1st. So we're testing that, and we performed our preliminary fieldwork procedures on the 2013 audit. And then we are scheduled to receive trial balances on or before May 5th, and our team would arrive the week of May 12th to begin the audit for 2013.
Question?
Yes.
Andrea, thank you for coming. Andrea, one of the words we had looked forward to with the 2012 audit, we had talked about the word unqualified. You have used the words unmodified, comprehensive. Can we essentially equate the two as to what we were expecting more or less? That unmodified, comprehensive, this is what you may call, in the past we got qualified audits, which you deem as an unqualified audit.
Yeah, the terminology has changed actually under auditing standards. It used to be referred to as either an unqualified opinion or a qualified. So you used to have a qualified opinion. Under the new standard, it would be a modified opinion. You have received an unmodified opinion, which means there are no exceptions to the rule in accordance with generally accepted accounting principles. So we were able to perform our audit without saying that there was something missing from those financial statements.
And so for 2011, you had talked about what the number looked like, what our actual money was at that time. That was based on qualified audit. A qualified audit in 2011 said this is how much you have, that we believe you have anyways. On a qualified basis, that's how much money you actually have left to pay. Is that right?
Right. What we needed to do was go back and audit some of those beginning numbers, those ending numbers at December 31st, 2011. So that required a restatement to your financial statements, 2011's numbers needed to be restated.
And we
So-
can't, for the veracity of 2011's qualified audit statements, that we can't make any judgments on those at this time.
Well, right, well, there's certain things that were not done, yes, that's correct.
And slide 11 was an interesting one. That originally showed over the last few years how it originally looked like at some point we had $18 million. But I think as you had, 13, thank you. But as you had said, that was 13 that looked like it was actually money, but in fact what that was borrowed funds, and that was actually another way to say that was a debt, a loan that we had taken out that looked like money, but in fact it was money that we slowly been losing the entire time.
Yeah, there was money taken out to fund operating deficits. So the amount of debt that's outstanding, about $92 million. We went back to look to see how much was incurred for prior operating deficits or paying pension. About 30 million of it was to pay pension obligations, and the remaining was either refinancing to pay debt service on current debt that was due because we couldn't make debt payments, or it was to fund operating deficits.
So to just be clear, so some of the revenue that we thought we had, or some of our remaining assets that we had all the end of those years, in fact, there wasn't really actually money that we just had to use at whatever discretion we wished. That was actually bond money, borrowed money that we actually had. We're on a repayment plan basically that we had to pay at some point here.
Yeah, I mean, you were running a deficit, so you needed to pay for the bills, so that was
Look good on paper, long term, no, not good.
No, because you have future obligations to that.
And just one of the things we talked about in the beginning is the 50% on the back taxes. That was, we had double booked basically something in 2012 that we had previously used.
Yeah, what had happened was, and this actually became a result of our audit, when we looked at the tax revenue that was recorded, it had been including tax revenue that was already recognized as revenue in 2011. So when we reversed out that to go to an accrual basis versus a cash basis of accounting, that resulted in your tax revenue being lower on an accrual basis of accounting.
And that's something you found through your 2012 audit all these years later. I assume it's not something that was just standing out there for everyone to see. That's something you had a ring for to see.
Yeah, it became, what happens is in governments is that they usually recognize 60 days out of revenue in the previous year. So that accrual that was made in 2011 was never reversed in 2012. So it was a typical entry that's made to reverse it out.
And the way we've done an unmodified audit this time will just make it easier for us to, again, repeat this perhaps in a shorter time frame from 2013 now that we've taken all the procedural steps necessary to get to this unmodified status.
Yeah, I mean, there were certain things, the one standard had required an actuarial valuation that had to be done, so that was completed, that takes time, so that will not have to be incurred. All those beginning balance audit testing that I had to do, that also, I mean, we can rely now on the beginning balances.
And the other big area you said besides the double counting really on that back taxes was in fact those layoffs. Layoffs that didn't occur for 3 months that were on paper were supposed to happen January 1, 3 months later, all those jobs still here, and as a result we accrued millions more as a result of these people being on for really essentially 3 more months than budgeted for.
Correct.
Okay, thank you.
Yeah, I had a couple of questions that I asked you when you presented to the committee. And the one that I didn't ask about is the slide that you had on future debt service, which showed that for this year, we're actually going to pay more in interest than we're paying on the principal. Is that all calculated, you calculated it for the next 4 years and then thereafter? Is that based on the interest rate that we're paying now?
That is correct, yes.
Okay, so if we can possibly refinance it, that slide might look different next year.
Absolutely it will, yes.
Okay, terrific. And then the other question I had was about this, I believe I did ask you about. You said you did a modified payroll or a sampling of the payroll. You didn't do a complete audit of the payroll. Is that something that you would do, or is that something that would be done maybe by our controller or somebody?
Yeah, I mean, the controller's office can do internal audits. I refer to them as an internal auditor on a specific operational piece of the county. That's what I see in other counties. That's, you know, they have a plan that sets out on certain areas that they want to look at, and that would be one of them, yes.
Okay. And then petty cash and purchasing, did you also look at those areas?
Yeah, as part of our audit process, yes.
Okay, and you looked at internal controls on purchasing and aspects of it, or not?
Yes, yes.
Okay. So do you have a complete report? Is this all finalized now?
Yes, it is.
Okay. And so management is aware of all of you know, what you've seen in terms of, and if you could just remind everybody of the terms that you used the other night about the two different types of findings.
Oh, yes, actually. Yeah, there are three different types of findings that we issue. The terms are referred to, first one's a material weakness. That's a deficiency that we've evaluated, or a combination of deficiencies in internal control, that there's a reasonable possibility that there could be a material misstatement to your financial statements that could not be prevented or detected on a timely basis. So a very good example would be the tax entry that I talked to you about. That's a material weakness because your internal controls did not catch that prior to us catching it as part of our audit process. And we evaluate it as being material because it made a significant impact on your financial statements. Significant deficiency is less severe than a material weakness, and that, again, we evaluate it on materiality, but it's important enough to bring to your attention, so we label that as significant deficiency. So we're recommending, you know, those are things that we say you need to, like, there's no wiggle room on that. You need to implement this particular procedure in order for you to have a strong internal controls. And finally, we have constructive service comments, and these are just recommendations to improve your internal accounting controls, and you need to evaluate them whether or not, you know, they make sense to you, if they're cost efficient, you know, and those type of things. But that we see best practices are also a part of those comments.
So if you identify a material weakness in this year's audit and significant deficiencies, you would expect to see, not to see those in next year's audit, in the audit for 2013?
Some of them potentially could be there depending on, for example, segregation of duties.
Mm-hmm.
So, you know, if there was a segregation of duties and those particular duties are still being handled that same way during 2013, we would have to issue it again.
Right, but given that it's already 2014, you would expect for sure not to see them by the end of 2014, right?
Correct.
Okay.
I mean, right, if you're making those changes, which, you know, we address them during our audit, and management puts a plan, county manager, Brian, they put a plan together that says this is what they're going to do. So,
Right. Okay, thanks.
We go.
Yes, I noticed the Human Services, you didn't have Veterans Affairs with the Veterans Department included there?
I'd have to get back to you. It's part of the county as a department?
Yes.
Then it is, yes. It's in the non-major fund, though. It's not grouped with the Health and Human Service funds. It would be its own separate fund and accounted for.
It is in the Human Service Division.
Okay.
Department of Department.
But it is, yeah, it's definitely accounted for separately.
The delinquent taxes that you talked about the first 2 months, was that approximately $3.5 million? Is that the differential that we're seeing there?
Yes.
So that's pretty much the entire difference between what we thought we were supposed to collect versus what was actually collected.
Correct.
And maybe a little bit of an opinion. With this type of audit, is this a step towards getting a credit rating to the county?
Yes. Yeah,
This is
I mean, there's
something-
other things you need to do, but
I
yes.
understand, but
that's-
I mean, as far as
that
from the
is a
audit
big-
perspective, is
a
this
big
something?
step, yes,
Thank you.
absolutely.
Harry, question?
Yes, you spoke about restating certain fund balances at the end of 2011.
Yes.
Could you talk a little bit about the magnitude of those and what that tells us?
I wanted to see if I had a slide. I might have a slide. So right down there at the bottom, it says restatement of beginning fund balance and net position. So there were adjustments made to, remember when I was talking about government-wide financial statements, which is your overall full accrual statement of basis of accounting? That was an adjustment of $22.5 million made to decrease that net position. Okay, so that was the magnitude of the restatement on the full accrual. Now, on the fund statements, that's the modified accrual. So, for example, your general fund, we had to adjust the fund balance by $680,306. Office of Community Development was $9,500. Health and Human Service Funds, $483,000. Flood Protection Authority was $1.2 million, and the non-major funds were $2.1 million.
So is this just as if somebody makes a mess out of their checkbook and they finally say, okay, I'm just going to buy into whatever the bank told me, and you sort of start over? Or does this indicate that money's missing? Is there any, what does this take? What does this say?
Oh, no, it indicates, well, each one indicates a different thing. The large $22.5 million one really is a result of not implementing those standards. So $8 million of it was relating to the post-employment benefit plans that was never recorded. Okay, a big portion of that was your derivatives on your swaps. That was over $20 million. That was also, or I guess it wasn't 20. Sorry, it was less than that. It was like $12 million. That piece was never recorded. An entry was never recorded. So these were accruals, liabilities. They didn't relate to your bank accounts.
So this changes our balance sheet.
Right.
We thought we had assets worth X dollars, and really we had $22 million less in assets. Is that fair?
You had $22 million more in liabilities.
Or liabilities.
Yeah.
So net assets.
Right.
And how about the ones that the general fund, the $680 million or $680,000?
Those again related to receivables, I believe, that were not collectible, that needed to be adjusted. But none of them were cash accounts. Everything related to a liability, an accrual, or a receivable that was not a valid receivable.
So these were accounting problems. These were not behavioral problems on the part of
Correct.
staff or elected officials or anybody else. Is that fair?
Right. I mean, things were not audited. So when it's not audited, it may not have been adjusted properly.
Great. I think another question, Mr. Boback, we began to ask about the efficiencies and what we've learned and the possibility that the audit for 2013 might go smoother because you have the initial fund balances corrected now, and you've gone through the process, and the staff is a little more familiar with the process, and hopefully New World will be more responsive than dealing with the ACS and New World system. Does that translate into a reduced cost for your services in 2013?
I always get that question. If we could be more efficient, yes, we would pass those savings.
Well, I don't misunderstand. I'm thrilled that we have this, and I think that, the new form of government has been criticized for many things, but I think we are finally disclosing in a mildly understandable form the state of our financial condition, and I appreciate that and the professionalism that you and our staff has done to do this. And I know it hasn't been simple and it's been dragged down longer than we hoped, but it really is very impressive, and I appreciate your service, as well as the support from Brian Sweats and his staff and the manager to provide the information to you to do this, and I thank you all. Thanks.
Yeah, I mean, it takes the whole county.
Any questions? Sure.
Can you pull up the expenditure chart, the spending chart first? I know you touched on the
departments have overspent. Could you go down public safety, that's 700,000? Who is that?
Public safety is the 911.
Okay.
So in that line item, and what had happened there was the reimbursement expected from 911 was not as high as had been budgeted for, those costs. So that's why the costs are higher than, the expenses are higher than budget. So it's actually a net number. So what the general fund expects is a transfer from the 911 to reimburse certain costs, and that was lower than expected.
The debt service, that the interest wasn't expected.
That is the, that is your TRAN, which was referred to as your tax anticipation note. So when you take out your tax anticipation note, where you need cash before your taxes come in, that's the interest that you paid on that debt service for that time frame.
Okay, and the correction form, could you highlight where the spending was at, corrections?
Corrections, the 4.4 million. So the budget of the 26.9 million was, the assumptions within the budget were that the correction officers, certain correction officers would not be employed by the county during 2012, the beginning. So when that was not, when they were paid through March of 2012, that caused it to be over budget.
$4 million.
Isn't part of that the day reporting center though? The million on the day reporting, is that part of corrections or is that somewhere else? So we do budget.
Yeah, it's part of correction.
So that's part of that reason, Bill
Yeah.
Mill was that day reporting, which is the other three is out.
No, the other thing is though, the question that was asked, I think you answered it. Although that money was borrowed in 2009, and you showed additional revenues available every year, it was like $3 million more. There was still $3 million of real money that was in an account that was spent in 2012. And that borrowed money, you showed that chart. The money that came from the bond.
Right. There was money, fund balance at the beginning of 2012 was 3 million, right.
So that was a $3 million fund balance.
Yes, there was, yes.
How familiar are you with the chart? How familiar are you with the chart?
Familiar with it, yeah. I am familiar with it, yeah.
Is there anything in the chart that allows the manager to spend more than he's authorized by the county? Give me a process.
I'm not sure if you're saying that,
If council passes a budget of $110 million,
right?
is there anything that says he can spend $120?
I'm not, yeah,
Well, she's familiar with the charter. I want to know if she found any language that allows that to happen without coming to this body and getting additional funds or additional expenditures.
the other finance board, not.
I don't know.
Thank you.
Jay?
I just have a couple questions. This one might have been answered, but the debt service for 2014 should be $27,193,098 due to the increased interest, and you have like 25 million here. So and then there's a little error here. What's that?
For the from the footnote that the 2014 debt service, I can reconcile it back to, what you have.
Okay. And the internal service fund, workman's comp, has a net deficit of $1,654,012. Where does the money come from to resupply this fund?
What happens with, let me just, So the internal service fund, as of December 31st, 2012, had assets of $1,483,000, but it had an unpaid claims reserve of $3.1 million, which is a number that's calculated from an actuarial report. However, the state does not require you to fund that entire amount. So what the county has decided to do is fund what is required, legally required to fund.
Thank you.
Kathy?
Okay, thank you for coming in again. Plus, I do believe you have a question from the audience, if you were here at the beginning of the meeting, to explain perhaps, and I have other questions, why you were not here at the last county council meeting that was arranged.
The answer to that question is I didn't put it on the agenda, Kathy, you know that. There was no communication from your committee to my committee, and that's why. And I said it's responsibility of council members to know, and therefore council members wanted to see it, and I put it on to this committee. Pretty simple. Now let's stay focused on the agenda, on the audit.
But I didn't ask you, Mr.
I've
Chair.
given you the answer to the question, okay? Thank you.
Moving onward,
Please move forward.
this is a corrected, updated version, or is it the same presentation as on the 8th?
Same presentation.
Okay, then I went to a Flood Protection Authority meeting to clarify what were presumptions made in this presentation, and that is service that is provided. And secondly, another error or presumption made, the 1.1, almost $0.3 million that's allowed to stand as part of this budget is always going to be an error in your report, because that money is not county revenue. How are you going to address that and fix that error? And then my third big thing is, as was pointed out by Councilwoman Howe, which was very good, is that the county council needs weekly reports on the 2013 audit. Will you do that?
Yeah, well, I'll answer that one right away. Yes, we will. We'll be providing weekly updates. We have an outstanding list of open items that we request, and each week we'll discuss that, where we stand, and we'll keep council apprised of where we stand on that list, along with all open items, and give you a status. As far as the Flood Protection Authority, the Flood Protection Authority is a separate fund within the county's financial statements. We do not do that audit, so the Flood Protection provides us with their audit, and it's considered a fund. So all their activity is not within the general fund, it is separate. Yeah, it's on your combining statement of funds. However, it is completely separate, the activity, and audited separately. Within the general fund, there is a transfer to the debt service fund that you budget, that is to pay for the Flood Protection Authority bonds. So that is the only thing that is included within your, within your budget.
And that bond was taken out by the county, and it's the county's obligation in 2009. The fees were meant to start generating money to provide the protection of the citizens living in the area that it needs to protect, but the county is obligated to pay that money.
Yes, the county guarantees that. That's why the flood protection is on your financial statements. And actually, the flood protection shows the debt also on their books. So when we reconcile your audit or your combined full accrual financial statements, we have to we can't have doubled the debt. So we eliminate the debt that's on the Flood Protection Authority, and it becomes all the debt of the county. So it's actually on there twice. If you were to look at separate financial statements, it's there as the flood protection debt.
Okay. Thank you very much. Appreciate it. Back in.